Driving through any modern city, you're surrounded by the physical reality of economic growth. Roads expanding, concrete pouring, and power grids lighting the skyline. Governments simply do not have the tax revenue sitting in a vault to pay for all this massive expansion out of pocket. To get these projects built, they rely on public-private partnerships, bringing in outside companies to execute the work. This creates a unique problem for the private sponsors. An engineering firm might have the technical expertise to build a billion-dollar suspension bridge, but they rarely have $1 billion in cash to fund the construction. Securing that scale of capital requires an approach to borrowing that is completely detached from the credit of the parent company. Normally, when a business needs money, they rely on traditional corporate finance. They go to a bank and take out a loan backed by the assets and steady cash flows they already have. But if a company puts a massive billion-dollar mega project directly onto its own balance sheet, that single enormous loan exhausts its borrowing capacity. It suddenly has no financial flexibility left to run its normal day-to-day operations. There is also the threat of total loss. If the new mega project fails, the creditors have the legal right to seize the sponsor's older, successful assets to recover their money. Taking on an infrastructure project this way puts the entire parent company in jeopardy. The sheer size of the debt makes traditional corporate borrowing a risk to the firm's survival. To build the project without risking the parent company, sponsors engineer a legal firewall. They create a special purpose vehicle, or SPV. This is a newly minted independent company designed to do exactly one thing: own and operate the new project. Because the SPV is a completely separate legal entity, the new project lives entirely off the sponsor's balance sheet. The new infrastructure and the existing engineering firm now have two distinct financial lives. Sponsors inject a fraction of the total project cost as equity to own this new SPV. If the project goes bankrupt, the sponsors only lose that specific initial investment and nothing more. This ring-fencing shields the parent company's core business. It allows a firm to coordinate billions of dollars in new debt without risking its own assets. But this creates a strict limitation for the banks. Since the SPV has no history and no other assets, lenders can only rely on the project's future cash flows to get repaid. This diagram maps out how an SPV structures itself to secure that loan. It drafts contracts to distribute specific risks out to the parties best equipped to handle them. Construction delays are assigned to contractors, and material issues are pushed to suppliers. This graph tracks the debt service cover ratio. It verifies if the leftover cash safely covers loan payments. Notice the blue and red lines stay above the baseline. Lenders stress test these projections against downside scenarios to ensure the project won't default. By successfully shifting every critical risk away from the SPV through these contracts, the project locks in predictable cash flows. That predictability is what makes the project bankable. Once construction finishes, the physical asset actually has to generate money. On a toll road, that means collecting direct physical user fees from drivers. The money gathered from those tolls forms the pure, unlevered revenue. This is the operating cash flow that becomes available to pay down the project's massive debts. This money distributes through a tiered cash flow waterfall. At the top, taxes and operating costs. Once covered, money flows downward to service bank loans, then emergency reserves. Sponsors sit at the very bottom, receiving dividends only after every obligation above is satisfied. While traditional corporate finance relies on the safety of historical assets, project finance relies entirely on the successful generation of future assets. Setting up this isolated system is highly complex. The intense risk allocation and strict contract negotiations mean transaction and structuring costs easily consume 5 to 10% of the total investment. Sponsors pay this massive transaction premium because it allows them to preserve their financial flexibility. It protects their core operations from the weight of mega-project debt. In practice, project finance acts as a structural safeguard for corporate survival in the face of massive industrial risks. This financial technology is the engine powering the world's shift toward modern, sustainable infrastructure, like large-scale solar farms. Because public needs continually outpace tax revenues, governments must rely on private companies to bridge the gap using these intricate funding structures. Funding global infrastructure requires a foundation of engineered trust, a system that aligns risks, rewards, and legal protections into a single bankable reality.